Welcome to the Beat the Banks podcast. I'm your host, Kyle Fuller, and I'm in our studio once again with the one and only Mr. David Zapata, fellow partner here at Factom and also IBC practitioner. And today, David, let's dive into the problem that Nelson Nash identified in his book, Becoming Your Own Banker. And he literally calls it the problem.
Yeah.
So what does he mean when he's describing this problem?
You know, the wisdom of Nelson's thoughts is infinite. I think that's why he probably started thinking about infinite banking. But I think at the prom, what he was really trying to do was try to crystallize, to put in front of him in paper, what is the cause, not the effect, not the symptoms. What is at the root cause of the fact that most people put headwind in their financial lives, right? And he's talking about the things we always talk about in our foundational content, the idea that we only have two options. There's a coin with two sides. We either use credit, right? Or we use our own cash. And for most people, those are the only two available options. I either will go and use somebody else's money that has had the discipline to accumulate it. They're going to lend it to me. And for the willingness to give me that money temporarily, they will expect that I pay them interest with my future income. That is a very, very clear arrangement. It could not be clearer today with $1 trillion in credit card balances in our economy for the first time. People are very familiar with that. And with that familiarity comes the wise grandfather or father that says, you should not be paying interest to somebody else. You should use your own cash. Well, let's talk about that. Nelson is very wise in recognizing, well, if I went ahead and used my own cash, I send money away in exchange for the things that I want to finance, that I want to purchase. But I will forever, and I want to say that again, forever, interrupt the ability to earn interest on those dollars for the rest of my life. And that, my friends, has a cost. It has a significant cost. And the fun part of this is that it's an exponential function. We have a really hard time measuring how impactful that cost is over time, especially over our lifetimes. So he's talking about the fact that we finance everything in life. And if we use those two options, and on top of that, we have a third-party bank or a third-party entity managing the banking function between those two things, we are just effectively sending money away constantly. And we are putting headwind in our financial life instead of building tailwind.
Absolutely. That's a great analogy, right? You're fighting against that headwind when it doesn't have to be that way. And so I'm going to sum up what you just said. You either pay up interest to use someone else's cash, which we call an interest payment. And you talked about grandpa, father, now son. That was the hierarchy for my family. My grandpa paid cash. So what did he do? He taught my dad to pay cash. What did my dad do? Taught me to pay cash until I recognized that this was happening. And then I'm the one that really changed everything for our family because I thought I was being the most effective by paying cash. But what you just said, you described an interest cost. So I paid cash for my first vehicle, $3,200. Soon as I wrote that check and gave it to the seller, that money was gone from my control forever, which is what you just said. That's what we call an interest cost. And the interest cost is what could those dollars have earned me had I had it in an environment that I owned and could earn true constant compounding forever on it. Yeah. That number is really big over a lifetime.
Yes.
Bigger than anyone really understands.
Probably can see. Yeah.
And the frustrating part, David, hence our slogan, Beat the Banks, whether you pay cash or finance, the banks end up with all that money anyways. Like people think, oh, I'm paying cash, so the banks aren't getting my interest. Well, what did the guy do that I wrote that check to? Where's the first place he took that check?
Deposited in his bank.
He deposited it in the bank, and guess what they're going to pay him? Next to nothing. Guess what they're going to do with that? Lend it out to someone who needs financing.
Yeah.
Man, oh man, if we could just be that person in the money game. And that's hence the whole idea behind becoming your own banker. You can actually be that person in the money game. So let's talk about the average American. You know, I was really shocked when I started looking at these stats and I'm like, you know, how many vehicles does the average American own and drive in their lifetime? And the number is about 13 vehicles. And the average vehicle price is about $30,000. So 13 times 30,000, 390, right at about $400,000, we'll say, easy round numbers, that we will pay just in vehicles, whether we pay cash or finance. It's like right there at the same. Now, prior to knowing this concept, David, had we kept owning and driving vehicles, financing them through someone else or paying cash, how much money would you and I have left at the end of our lifetime? Let's say we're 80 or 90 years old at that time. How much of those dollars are left in our control?
Zero.
Zero.
Yeah.
because we're constantly transferring it away in the form of an interest payment, or we pay cash and transfer it away in that form as well. Makes no difference. And the banks literally don't care because they're going to get it either which way.
Yeah. One point that comes to mind when you say this is, and it's something that I've been very intentional about inviting my clients and the folks that I'm having conversations every day. There's a thoughtful process here. We talked about this in a previous episode. Infinite banking and the banking function in general is not just a product, it's not just a set of rules, but the combination of those with a set of ideas. And part of those ideas is, what if you develop the mindset of the banker? What if you, for example, started separating the idea of purchasing a car, and we use a car because it's very relatable for our culture, for our country, right? With the idea of financing that purchase. Those are two different parts of the conversation. And what we are going to talk about here is the financing part of that. There's multiple options, more than most people think. But at the end of the day, we're buying a car, we're buying a car, we're buying a car.
Right. And it's something that we need to recognize is happening, which is why we preach and educate on awareness early on in our client journey, right?
Yeah.
You got to be aware of what's going on. And so I've got a truth concepts calculator pulled up in front of me. Now, everyone on the podcast can't see this, but you can go to our website, factumfinancial.com, click on IBC resources, and go find the video called IBC and Vehicles, or IBC for Vehicles. And you'll see the differences between paying cash, using the banking mindset, and then coupling the banking mindset with a more efficient savings environment, which we're going to recommend whole life insurance for that.
Yeah.
And if you have those three elements, that's where you really get something magical. Because the reality is, David, you could bank or become a banker with a lot of different products. You could continue doing it with a checking account, 401k. You could do it with real estate. The problem is when you compare like banking tool or banking environment to other assets, there's no other asset that has those 8 benefits we talked about in previous episodes. That's why we put the whole life at the foundation as your savings environment and your primary banking tool to make this process function really well with as little noise as possible. So let's dive into this. In this example, we're going to fund a policy $10,000 for 8 years. So we're depositing that money into premium, and then we're going to scale it down to $3,620 for the ongoing years. And the reason I picked these exact numbers, because even with the principal and interest we're going to pay back to our banking system, it arrives at $386,000 net. So it's like we're right in that realm of what the average American's going to spend, $400,000 on 13 vehicles, and end up with nothing to show for it. And in this example, we're shifting to a banking mindset. So we're going to start funding our whole life policy. And in the 4th year, we're going to take a policy loan to go purchase a $30,000 vehicle. Now, when we take a policy loan, David, we're going to the dealership or wherever it is, we're paying cash for that car, right?
Correct.
So we don't owe any third party that amortization payment, nothing like that, right?
Correct.
But who do we need to pay back now?
The insurance company.
The insurance company where our banking system is residing. So there's no difference in what people are already doing. We just created a better environment to do it in. And the environment you're in will dictate exactly how successful you're going to be. So we're going to pay back this banking system at 7% interest. Once again, I picked that number because it helps us arrive right at that $400,000 mark. And over the 13 vehicles financed every 5 years, instead of ending with 0, David, we end up with $1.5 million. Did we work any harder?
And you bought the same cars.
Same cars. We didn't work any harder.
Nope.
We definitely didn't take on additional risk because this asset is guaranteed. We're in full control of this money, but more importantly, all those dollars that are going into premium, we're earning that interest cost on them for life.
Yeah.
Compare that to a checking or savings account. As soon as money flows out of that account, it's gone forever. That's just one of the benefits. But this system I'm looking at, and if you want to see the numbers, hop over to our course. These numbers in here, did they show up in any credit report? Are they reportable? Is the IRS or my CPA know?
Completely private.
Completely private. And you want to know why it's private? Because it's not an investment, which is where people get this really wrong. Whole life is a private contract that you are committing to with a state-regulated, mutually owned insurance company, not regulated at the federal level. We've talked about American values in the past, and this is exactly what that is. It's a citizen, personal contract that's being made. And the reason there's also no income taxes involved with this is because this isn't a government-sponsored program. whole life predates the IRS, the income tax. It wasn't created to be some tax loophole. I think a lot of times when people are seeing this, they're like, this is too good to be true. This seems like this is a scam. Like, what's the catch? Is this a loophole? And we're like, it's not, because this asset existed before all of that was created.
It's rooted in American values of self-reliance, privacy, private contracts between two parties to protect each other. I mean, it is everything we think about when we look at that flag, when we think about our values, our democracy. So that's why it's so important to align intentionally. And that's what I hear in the conversation you just had. Intentionally choosing how we go about financing. By the way, I want to make this clear. We're not saying that you get wealthy by buying liabilities. I want to be very explicit. When you talk to professionals in this field, you'll see that the clarity on that is important, because there's a lot of misleading messages about that. When you buy a car, you're buying a liability, something that takes money away from you. There's a cost associated to it. And in this case, when we finance it effectively through the private banking system, we are assuming the cost of that interest, but is intentional because we control the banking function. You show up to a dealership and you have multiple options. You can lease a vehicle, borrow against the banking solution they have at the dealer. You can use your own cash. You can borrow against other assets. That was another point you made, right? This is not a conversation just for leverage. You can borrow against many things and you still will not be doing effective financing. Or you can talk about the conversation in private banking. When you are using the right ideas, the right mindset, the right process and rules, pay yourself with interest, right? And when you use the right platform, whole life, and you get all those 8 benefits, you can see the effects of thinking long-term and how that interest that you now control increases your ability to have access to that same money over a long, long period of time.
And that's what banking is all about. It's controlling that flow of money. So we end up with $1.5 million in our lifetime just by keeping the vehicles financed within our world. Yeah. Because essentially what we're doing is we're 2 players in a money game. We're a banker and we're still a consumer. And so, David, does a bank make more money if I go in there and finance a $30,000 Toyota Camry or a $100,000 Escalade?
Absolutely. The bigger purchase is much more better.
Interesting, right? So could Banker Kyle be better off down the road if I was financing nicer vehicles for my family?
Absolutely.
Why would it be any different, right?
Absolutely.
But where you want to be careful is there's a lot of marketers out there telling you you can get rich buying liabilities, and it's absolutely not true. No. Because it also costs me more as a consumer, right? So it's not magical. It's not mystical. Does a bank make more money if they finance 1 vehicle or 5 vehicles at a time? 5. More flows of money going to that entity. So what happens when you bring your family together and you got 5 or 10 vehicles being financed within the family? Does the family get richer over time?
Yeah,
absolutely. But it's a higher cost to the consumer if you're going to do more expensive items, right? Yeah. So it's not like this magical thing. You have to really understand the numbers, what's going on. But to me, it opens up the money game and allows me to have more fun playing it.
Absolutely. And, there's also another thing that I've started to think recently about. There's a time preference in how you think about these things. A lot of people make decisions of lease a vehicle, for example, because they're thinking short term and they're looking at the monthly payment and they want to minimize that to minimize the effect on cash flow. And there's validity to that thought. But if you zoom out and you look over time, all you're doing is sending that money away and renting a vehicle for a period of time. So you're going to end up in that point that you talk about, 0, right? When we talk about using this, is because you're the consumer and the banker, you are going to incur in the short term the cost of being the consumer paying for that Escalade. There's no question about that. You are buying a liability. You're not becoming rich by buying a very expensive car. That will be asinine. But what we are saying is that because you are also the banker, if you are going to buy the Escalade regardless because it's the right thing to do, you might as well be the person in control of the entity that's financing that purchase. And that applies for vehicles, that applies for vacations, for any other liability that's necessary in your life, health, taxes, anything else in your family, in your business. Why not make yourself the party that benefits from the interest long-term that is accumulated through those purchases?
And, Nelson talks about that in his book on page 52. Everyone should be in 2 businesses, the one at which you make your living and the banking business that finances whatever you do for a living. That applies to consumers too. Employees, self-employed individuals, business owners, and investors all need the banker. So why are we not getting into that business? So let's shift gears a little bit, because I think the reason We talk about vehicles, and we'll show that because it's very relatable to people. Everyone's purchased vehicles, paid cash, financed it. They've done it all. And when you show them what that's going to cost them over their lifetime, that's when people say, I wish I would have known this 20 years ago, that I could have done this. And so let's shift gears now, because once you understand that principle of banking, how to control more of that flow of money in your life, when you couple it with investing or your business where you tend to make most of your money, that to me is where it gets really exciting. That's how you actually win the money game. You do not win the money game by buying jewelry, vehicles, liabilities, and using your banking system. You can control that flow of money, but we want to play the money game the way it was intended to be played, by creating cash flow that supports our ideal life in 5 areas. So, which is why we love assets like real estate.
Yes.
You know, real estate produces cash flow. I mean, hopefully you're buying real estate that produces cash flow, gives you tax benefits, and appreciates on average over time. Anytime you can buy an asset that appreciates in value, lowers your taxes, and produces cash flow to support your ideal life, buy as many of those assets in the shortest amount of time to win the money game.
Yes.
So let's segue now and start talking about this for maybe someone like a real estate investor, which we work with a lot of real estate investors. So what problems do real estate investors have, David?
Well, at top of mind, I think that there's a couple things. Access of capital in the many forms that comes, whether it's leverage or their own, right? Where do they keep their reserves, and how do they access the money they need to do acquisitions, cost of flips, everything else, right? They definitely understand the pains of dealing with banks. We have this conversation on a daily basis. And then taxes, right? How do they control the tax liability they have by earning either money when they sell a flip and they have capital gains, or income tax when they just continually draw cash flow from their investments?
Yeah. So here's the interesting part is the real estate investors have the same problem as everyone else. They're still financing everything in life. And where I feel like a lot of the real estate investors have their pain is what you just described. They have cash sitting in some type of checking or savings, some type of liquid safe environment. And it hurts them because they know they need to keep money in motion. That's how they win. It's a true principle of winning the money game. But their savings environment is so inefficient because that's what everyone else is using too. So they're always trying to, almost being impatient to find the next deal. The reason why real estate investors tend to love what we teach is when you have that private banking system working for you, better savings environment with those 8 benefits, our policies are growing thousands of dollars per month, completely income tax free, no risk to us. That allows you and I to be so patient in the money game and wait for great opportunities to come by our table. We're still looking, but we're not in a rush to look.
Yeah.
What does that do to your emotional self, just your well-being overall? And so when you couple a strategy like real estate investing, which usually is long-term thinking, buy and hold, hopefully for 30 years, pay those notes off. What happens when you couple that buy and hold strategy with, I'm going to say, the greatest savings environment ever over 30 years? So now all those mortgages are paid off. Does that not jack up the cash flow they're producing?
Incredibly.
So the question is, 30 years from now, are you still going to need a place to store cash? Well, is there anything better than a 30-year-old policy that's been compounding for that long? Well, maybe a 31-year-old policy, right? Like 70 years. But if you put those things together, I'm looking at another calculator right now. Go onto our website and look at, IBC and real estate. 30 years into a policy that someone's maybe front loaded for real estate because they got a lot of cash, which you can do with these policies. Let's say they're paying $25,000 a year in premium. 31 years in there, they deposited in $25,000. That policy is going to grow somewhere around $80,000 that year. Imagine if your cash flows were $25,000 from your real estate. You direct that into your policy. It's been compounding for 30 years. And by the way, how much protection, death benefit we got in that policy at that
Multiples.
time? Millions.
Yeah.
What a great, compare that to what most real estate investors are doing with just cash accounts over 30 years.
Yeah. When you start talking about assets now and financing assets, this conversation explodes because it becomes an exciting place for creativity. And that's the place that I actually love living in this conversation. Absolutely agree with you. And especially when it's focused on cash flow. One thing I can even tell you the moment in my meetings when I'm talking to a real estate investor, the eyes change when they realize how much better would my business get if I have a place to send money and store it properly and it continues to work and I have no FOMO, but I'm thinking tactically now. That's one thing that huge changes the conversation. Number 2, What if I have access to that money on a basis where I become the loan officer? So I determine the terms, I determine how it's accessed. What if you wanted to match the depreciation of your buildings, of your homes, and how you set up the amortization schedule and how you repay? You become a tactician, and you elevate yourself to a creative plane versus a reactive plane. The other part is, what about the other benefits, the other six that we always talk about, the protection, the privacy, right? It's a different place to think about. And it's the idea that when you bring your business, whatever you do in real estate, and you add the banking component to it, you are in control. That's what we mean when we have this conversation.
Absolutely. And it's why you want to get into the banking business for your personal life, your business, or your investing strategy. And so just to wrap this up, the average consumer, the average American, is going to miss out on about $1.5 million by not implementing this process for just the vehicles. When you start adding in your investments into this, and depending on how good of an investor you are, that number is going to be 10, 20 times what it would be for consumers buying vehicles. When you're now calculating the interest cost and what you could have kept in your control by having all those dollars flow through your own private banking system for your investments. I mean, I know real estate investors that are, they've got millions and millions of dollars flowing through their hands every year. But the question is, as a banker, how many of those dollars are they keeping?
Yeah.
When you start to calculate that number and people see it for the first time, I think it keeps them up for a few nights.
Shocking.
They're going to be thinking about, I could have had how much in my control now and in the future, which is why the earlier you start this, the better off it is.
One last thought before we close. I love this idea you've put in front of me. Whether you are the income earner, W-2, whether you're a small business owner or a big business owner or an investor, the way the IRS sees us and the way that Robert Kiyosaki laid out the cash flow quadrant, all those people need a banker. And I would encourage you to consider that perhaps it should be yourself.
I would say that is the only person it should be, right? Well said. Well, we hope you enjoyed this episode today. Make sure to go over to our website, factumfinancial.com. Check out our free resources. You're going to see this entire conversation we had with all the numbers, which is very important to understand the details behind the conversation that we're having today.